This 10-day rally coming into today's session, if it is a bear market bounce, it would be the 5th best bear market bounce in history. Now, I'm in the camp that thinks this is a pause to consolidate recent gains and could be the beginning of a bigger leg higher. Joining me now to discuss two of my favorite market watchers, Aaron Gibbs, Kenny Polcari, both in studio. All right, Kenny, I'll start with you because you've been cautious. So is this a bear market bounce or something different?
I think it's a bounce. I think it's a bear market bounce. I'm still in the camp that there's rocky roads ahead and trouble ahead once we start down that road with the Fed. And once investors in the markets understand that based on even today's inflation data, that the Fed is going to have to become more aggressive. And that's why I think we're very much in a trading range, but I don't think it goes much higher from here.
You were more constructive, though, last time we spoke, Aaron.
Yeah, I think that we can certainly, though we've broken past the February peaks, I think we're heading back towards January peaks. So while I'm not sure that we're going to completely break out of, let's say, not a full bear market.
January for the S&P, early in the month, we hit an all-time high. So,
yep.
I mean, we've got some short-term hurdles. If we clear them, what's in the way of us not going back to at least retest those highs?
Oh, I think we're definitely heading towards those highs. I think, like, even when you look at value, it's almost already there for the value indices. Growth's just the one that's got to pick it back up. But, yeah, I think there's certainly room to consolidate after such a long, striking move up. Sure. But I think we're going to test those highs again.
Kenny?
Right. So I think we're in a broader, I think for a while, we're in this 4,420, 4,800 trading range. I think that's what we're going to see. So do I think we could test higher? I think we could, but I think we're going to run into resistance like Aaron when we get there. There's not going to be a reason to push up and through just because there's still a lot of uncertainty over Fed policy.
The market doesn't like uncertainty, but what out there could be a surprise at this point? Some people are calling for 75 basis points hikes. I mean, it feels like all the bad kind of news is out there. And maybe we can only get positive. When it comes to surprises, it feels like the only surprises could be positive.
Well, I think we're still really uncertain about inflation. I think, all the forecasts have been consistently wrong, right. And it keeps coming in higher more than anybody expected.
You don't feel like today was the top?
I felt like we had tops beforehand back in January. So I think we got to see just 1 month where inflation's coming down, just 1 month where it's not coming consistently
higher. I think the momentum is higher. I think the momentum. So I think we're going to see a couple more prints that are higher than this. I mean, look, the CPI. I think they came out about 8%, but the month over month was up 0.9%. If you just annualize that, that's inflation at 7.2%. That's inflation at 9.6%. And so I think we're still behind, which is why I think we're going to start to move higher.
All right, so let's talk about bond inversion because it sounds very, very spooky. And we do know that it's got a great track record on sort of being a harbinger of a recession. Maybe a year later, I mean, within a year to whatever, 18 months. Yep. But the market does very well between the time we invert and the time the recession begins. So do you invest in this environment, Aaron?
Yeah, I think this is something that is still quite a ways off. And even if we have a recession, the market can frequently bounce back or even really sort of, ignore. If it's only like 2 quarters, sometimes the market just sort of goes flat. It doesn't necessarily become a full bear market. You really need like 4 or 5 consecutive quarters of contraction before you really see those big bear markets. So I think your best bet is definitely absolutely stay invested until we really do see any signs of a contraction. And then it really depends if it's going to be really quick and short-lived. Right. Could just be 1 quarter and not be a full recession.
Right. I'm not ever of the idea that you should get out at all. I think you should stay invested. It's just how you tweak your portfolio based on what you expect to happen. Right.
So on that, you were in value for a long time. Value is killing it.
Right.
More recently, growth is having its moments.
Right.
I mean, do you stay with that same composition where you're overweight value names, or do you start to tilt back to growth?
So I am still overweight value, although there have been opportunities, especially on the most recent weakness, where I started to nibble a little bit more at big tech, right? So the big tech names, kind of the ones that we all know, NVIDIA, Microsoft, Apple, even IBM, right, are names that I like and names that I started. But I'm still underweight tech. I'm still definitely overweight value because I think there's going to be rocky roads.
What about defensive? I hardly have any guests who say utilities. I mean, they're killing it. Yeah. Utilities are killing it. Yeah. If this is going to be one of those years, why can't utilities be a place where you outperform?
It just historically,
It's just not sexy.
It's not sexy. Dividend yields are not sexy. So yeah, I think also if they're going to outperform, it tends to be very short-lived. They're just not going to be the companies that are going to lead this economy.
Right, but out of two of the 11 sectors are up so far this year. It's energy up 40%, utilities up 4.5%.
Right.
Everything else is negative.
Right,
Yeah.
right. I mean, it's like, listen, I'm hardly ever exposed to it, but I think, you know, it wouldn't be bad this year. I'd rather have a utility than some of these staples, to be quite frank with you.
Right.
What are you buying? What do you guys like right now?